Hi, in this video we're going to continue our discussion about the key dates in a project finance loan agreement. Okay, so this is the part 2 of the discussion we started about the key dates in a project finance loan documentation. In the previous video and blog post, I discussed the key dates like the financial close date, construction start, construction completion, commercial operation date, technical completion, and financial completion date. In this video, we're going to continue and we're going to discuss topics like the availability period, calculation date, payment date, first repayment date, and final maturity date. Okay, so before we go into the topic, hi, for those of you who don't know me, my name is Hediye. I made financial modeling my profession as well as my passion. So if that sounds like something you're interested in, please consider subscribing. Okay, so let's start with the availability period. It is also known as the validity period or the commitment period. It's the period of time that the borrower has in order to draw down on the facility, on the debt facility. Okay, so it usually starts from the signing date, sometimes from the effective date or the financial close date, until the end of the construction of the project, until the time when the project is fully operational. Okay, so sometimes, most of the time, a specific date is specified in the loan agreement. For example, they say from the signing date of this agreement until the June 2023. Or sometimes it is defined as 3 months post construction completion, and as we know, construction completion has its own definition. 3 to 6 months post construction completion is the availability period, or sometimes just at completion. So these are the things that you need to verify, and it's also one of the important dates that is mentioned in an agreement. So now let's look at an extract from a term sheet. Okay, so as you can see, this is just extracted from a real term sheet. And this is the same definition that I just told you earlier. It says that the definition comes in the beginning of the loan agreement. There are all the definitions are mentioned. Among them is availability period. And in this specific one, the availability period is defined as the period from and including the date of this agreement to and including a specific date. Okay, and so as you say, this is the time that the borrower has in order to draw down on the facility. Okay, so now let's discuss how I use this date in my financial models. To be honest with you, I don't find anywhere I can use this date in my financial model. Let me know if there is any specific kind of way that you have found to use it in your own financial model, because in a project finance deal, throughout the construction phase, that's where you are cash negative. There are no revenues, so it's just during construction of the whatever is your project about, and during that time the only means of financing the cost are the debt and equity, or all the financing instruments that are available throughout the construction. Okay, so in my financial models, in a project finance and in a typical project finance model, the drawdown period, it's usually throughout the construction phase, so we don't specify it. However, if you want to specify the availability period, you can put it as one of the dates in your model, but just if you don't want to link it, or if you don't find a way to link it, just put it's for information purpose. Because as you know, auditors, they are sensitive to that. If you have an input or any cell that is not linked, any information, an assumption that is not linked to anywhere in the model, they will ask you to just remove it if it is idle. Okay, so if you still want to keep it as just for information purpose, you just put a note next to it that it's for information purpose. But however, I'm curious to know if you have come across a case where you had to kind of reflect the availability period in your model, and let me know how you use it. Okay, now we get into payment date. Payment date is also another definition, And as the name says, is the date when you pay your debt service. Okay, so that's a very important piece of information when it comes to the financial model, because the frequency that you need to pay your debt or your debt service, interest and principal, is basically defined under this payment date. Most of the time you have a schedule, a separate annex or a schedule within the loan agreement, which specifies the payment dates, June 2023, December 2023, blah, 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 going forward if it is paid out on semi-annual basis. And then next to it, you have the schedule for the repayment, whether it's in the money value, in the amounts, or in the percentage. That schedule is an important one. We're going to see an example when I show you an extract from a term sheet. So, and sometimes this payment date is separated for interest and for principal. So in the loan agreement, you will see a payment date of interest has a separate definition, and payment date of principal, which is sometimes called repayment date, it has also a different definition. So basically that's an important information when it comes to the financial model. And now we're going to look at an extract from a real term sheet. Okay, so this is the extract that I told you about. This is called schedule. This is a schedule and it's called a repayment schedule. And as you can see here, the payment dates are defined and are specified in this schedule. And you have in this specific term sheet, we had the principal date presented in form of percentages, and as you can see, most of the time they reflect up to 4 digits when it's expressed in percentages. Okay, so from here you know exactly the dates and the percentages of principal that needs to be paid on this date. Okay, now let me just open a financial model and take you through how I reflect this in my financial models. Okay, so let me open the financial model. So this is a model, as you're familiar with the type of models that I have. It's a typical project finance model. It is a modular, meaning that the calculations and the different calculation blocks are separated within different worksheets. So I'm going to take you through this worksheet that I call input C, which is for the constant inputs, and the input S, which is for the time-based inputs. Okay, so when we come to the timing assumptions, I discussed this in detail in my previous blog post and video on the how to build flexible timeline in a project finance model. I'm going to put the link down below if you're interested. Go and have a look at it. So today I want to talk to you about this basically parameter, which is the number of months in the model period. That's an important, very important decision that you need to make upfront with your team about the how you want to build your model in terms of the timeline and the number of months in each model period. And because as you know, one of the most important things that you need to report to the lenders, sponsor need to report to the lenders, and there are things that needs to be monitored by lenders are the debt ratios, basically historical debt service cover ratios, projected debt service cover ratios, LLCRs, gearing, and the different metrics. So the lenders, as we defined in the payment dates that we define, at each payment dates, and also there is another definition that we're going to see at each calculation date, they're going to ask for a report containing the calculation of these debt metrics. Okay, so your financial model needs to reflect these payment dates and these calculation dates. Okay, so most of the time when I'm asked about how should I build my model, should I build it on semi-annual basis or shall I build it on monthly basis, I would say that you need to look for your loan agreement and see how the loan needs to be repaid. If the lenders require repayment on semi-annual basis, I recommend the model to be built on semi-annual basis. Same thing if it is the debt service is paid on quarterly basis. So that's one of the factors that you can consider while building the financial model. Some people, they prefer to basically build everything, construction and operation, on monthly basis, and then they have the flexibility, of course, to then have the different consider different repayments for the different tranches of debt. That's good. That's going to make the model more flexible. However, it's going to bring more complexity because for each of the loan tranches, you need to build different flags and counter to reflect the frequency of payment of each tranche. So as I said, as I always say, there is always a trade-off between simplicity and flexibility. If you want to have, especially for models like projects which you need 35, 25 years of projection, you can imagine having a monthly model is quite complex and it's going to make the model quite heavy and complex. So you can do either way. There is no rule. However, I would just say that it's good to reflect basically the frequency of repayment of debt service and build your model accordingly. So for example, in this one, as you can see in the operation, during pre-operation, which is construction, I usually project them on monthly basis because it's a important phase for the appraisal. It is closer to the appraisal phase than the operation, and also lenders, they monitor it on monthly basis. However, when it comes to operation, I usually look at the loan agreements and reflect the frequency of debt service and build my model accordingly. Okay, and if you remember, we have seen this extract of the schedule, the repayment schedule from a loan agreement. If you have reached that stage that you had already gone through the negotiation with the lenders and you have a fixed repayment profile, in terms of the financial model, you just need to reflect all these repayment, all these figures, the percentages, or whether it is reflected in percentages or in dollar amount. You need to reflect them directly in your financial model. For example, here, as you can see, I have this what I call manual or sculpted or a la carte repayment profile in my model, where I can, once loan is signed, the loan agreement is signed, I would just hard code the figures from the loan agreement here. Prior to that, if the sponsor, they didn't start negotiating with the lenders, then you might want to consider like the let me take you there. As you can see, I have the other repayment methods like straight line and annuity built in the model as well. However, I always provide flexibility to have these manually sculpted, hard-coded figures in the model, because eventually you will need to reflect what is documented in the loan agreement in your financial model. Okay, next up is calculation date. I'm not going to spend much time on calculation date because it's basically the same as payment date, but sometimes it is defined separately. The calculation date and the payment date is basically, as we just discussed, is that there are dates that you need to report to the lenders, and they want to know about the certain ratios, the historical debt service cover ratio, the projected ones, the LLCRs, and the gearings. They want to monitor that, and they specify them under the calculation date. And and as I said, they are basically the same. The calculation date and the payment date, they fall usually on this exactly on the same date. Here I'm going to show you an extract from a real term sheet. As you can see here, calculation date is defined in this term sheet as any date of which the projected DSCR, the historic DSCR, and the LLCR and the debt to equity ratios are calculated. And they say under B, you will see that the calculation date means each payment date. So they are the same as the payment date. How do I use it in a financial model? Is, as I said, because they are the same as the payment date, the same thing that I just told you about the payment date also stands for the calculation date. So we are left with two more concepts, the repayment dates, and I'm just going to cover them next. Okay, next up is the first repayment date. So this is basically the date where the first installment of principal is due. And this is basically, most of the time, it is defined as the minimum of a specific date and X month, 3 to 6 months post commercial operation date. We covered the definition of the commercial operation date previously. So when you are reflecting it in your financial model, you need to consider both of these dates. Here is an extract from a real term sheet. As you can see here, first repayment date is defined as 30th of June 2021. and it is also defined as the first payment date falling immediately after 3 months after the scheduled commercial operation date. Okay, so scheduled commercial operation date is also a specific date that is defined in the term sheet, and this first payment date or first repayment date in this specific term sheet falls 3 months after that date, which is the scheduled commercial operation date. So how do I use it in my financial model? Let's go back to that financial model. So this is in the financing assumptions. I have in this section, I'm reflecting the debt terms for each tranche built in the model. I have 2 tranches in this one. So as you can see here, this is the first principal repayment date is defined here as one of the assumptions in the model, and it is calculated based on the from the drawdown date plus 30 months after 30 months after the first drawdown date. Okay, so that was specific to this term sheet, and because as you know, in most of the loan agreement there is a grace period. And the grace period is basically a period of time where you have moratorium on the principal repayment, meaning that you don't pay the principal during that time. You of course you continue paying the interest, however you don't pay principal, and after that you start paying the principal. So the first principal payment date here is defined in the financial model, and then I use it of course when I'm calculating the flags and counters for the debt. I use it for calculating the different debt flags that you see. This whole section here are the different payment flags that I use throughout my model in order to make the dates flexible, because as I always say, things change in a project finance or any deal. Things change through time, so your model needs to be flexible enough to reflect these changes. So this is one of the dates that you define in your financial models. And if we go now to the next and the last term, which is the final maturity date. So as the name says, this is the last payment date. Okay, if we go back and look at that schedule here, you see this was a schedule for a specific debt tranche, and you see this last one is basically the last repayment date, the final maturity date, and it has a specific definition, and it is basically in the term sheet, it is referred to a specific date. And if you have already signed your agreement, your loan document, all these days, including the first payment date and the last payment date, you need to hard code them in your financial model. However, if you still didn't sign the contract and you have some flexibility, like it is the case in this model that I just show you, I calculate the last payment date using the debt maturity, the term of the loan, which is 15 years. I use this 15 years maturity to calculate when I need to finish repaying the loan, and based on that we sculpt it, we basically calculate interest and so forth. Okay, so basically these are all the things that I wanted to cover when it comes to key dates in a loan agreement and its application to financial model. If you have any questions or any comments on what we discussed in this session, in the previous session, please don't hesitate to comment, and I hope to see you in my next video. And by the way, I have a blog post as well on this one, which I'm going to put it up on my website. All right, see you then. Bye-bye. If you want to learn how to build better financial models, check out my online course on financial model spreadsheet design at courses.phoenixmode.com.